Hello and welcome to Let's Talk Business. Now markets snapped their two-day gaining streak. Banks, NBFCs and the energy sector dragged the most. The markets, of course, dragged lower today. These were the sectors that dragged the markets lower. However, markets have witnessed the best week in over 2 months. Agam Vakil gets us all the details.
Well, it's turned out to be an extremely volatile week, and in fact, a weak end to this week, considering we did see the RBI come up with norms as far as your consumer loans are concerned, and that in fact weighed down on the entire banking sector along with a handful of large NBFCs as well. Now the Nifty has snapped a two-day gaining streak, and of course the benchmarks were weighed down essentially by some of your larger names in the financial space. Nifty was down around 0.2 of a percentage point, and Nifty Bank in fact was down by as much as 1.4% through the course of the day. In terms of the broader markets, they did outperform the benchmarks. We did see an advance for the mid-cap index by around 0.3 of a percentage point, and it was the same for the small-cap 250 index as well. In terms of key sectoral movers, we saw further advances for the healthcare space, and of course the pharma index also did well in today's day of trade, followed by a realty index which moves from strength to strength. But on the other hand, on the declines, well, no surprises here. It was largely the financials. In fact, we saw the PSE banking index down by around 1.5%, and it was the same for the private banking index as well. Finally, coming down to your key movers in terms of indices, we did see SBI Life, which was up around 4%, along with HDFC Life as well, which also moved up around 1.5%, and Apollo Hospitals advancing by around 1.7%. And on the declines, it was largely dominated by banks and NBFCs. SBI, along with Axis Bank, losing anywhere between 3.3 to 3.7%. And ONGC also declining by around 2.5%. But a lot of weakness coming across all major private sector banks, along with a handful of your large public sector banks as well. Well, we have seen weakness in today's day of trade. The real question is, can we see some recovery as we move into trade next week? Well, that's a wait and watch. With that, it's back to you.
HDFC Securities' Unmesh Sharma talks about the current market conditions and tells us why there is a lot of uncertainty looming in the market at the moment.
There is a lot of uncertainty. So what ends up happening in this situation is that either people sit back and try to look through this, which is what long-term investors do. The other is, which is what it seems to be the mood of the market currently, is to pick up on any cues which come up in the short term and kind of react accordingly. So if you see the way in which the market has reacted recently to the inflation print in the US, for example, and suddenly everything's become risk off, rather risk on, and risk off is off the table. I think that's what's happening. I think it's a sign that there is a lot of lack of clarity on what will happen in the next 6 to 12 months, and which is why every single data point is being seen as a pivot to the market moving in another direction. So to a large extent, whether you look at global macro or whether you look at local, I think uncertainty is basically what is ruling right now.
RBI has moved to curb high growth in unsecured personal loans and credit cards. The central bank has raised credit risk that weighs on unsecured consumer loans, making lending expensive. So what does this move really mean for lenders? Pragati Oberoi joins us with all the details.
The unsecured loans party for banks and NBFCs has ended. The Reserve Bank of India has announced a measure where it increased the credit risk weights on unsecured consumer loans. If I were to boil it down for you, here are the top 5 things that have happened. Earlier, the consumer loans for banks and NBFCs attracted a credit risk weight of 100%, but now this has been increased to 125%. However, the home loans, education loans, vehicle loans and gold loans will be exempted from this. Credit card loans by banks will attract a risk weight of 150% instead of the previous 125%. Those doled out by NBFCs will have a risk weight of 125% instead of the previous 100%. The RBI has also asked banks and NBFCs to define the exposure limits for unsecured loans. These limits will not only be at the segment level, but also at the sub-segment level. And lastly, from now on, the bank loans to retail NBFCs will also attract a higher risk weights. But let's not forget that the RBI had warned about very high growth in certain components of personal loans. In the October's monetary policy address, RBI Governor Shaktikanta Das said that the central bank was closely monitoring this segment for any signs of stress. So clearly, after multiple warnings, the RBI has sought to action, and this move is expected to have an impact in many ways. To put it simply, an increase in risk weights for lenders means that they have to set aside a higher capital against such loans. The lender's capital adequacy ratios gets impacted, and loans also get more expensive for the borrowers. With limits at the sub-segment level, growth strategies of banks may also see an impact, as now they will have to be very careful about where they are growing and by how much they are growing.
Now, to understand the implications of RBI's move, BQ Prime spoke to SBI Chairman Dinesh Khara and Axis Bank's Sumit Bali. Listen in.
We have been having the internal exposure limits also, sectoral limits also, that we build up various portfolios. So at the board level, we do have that allocation and conscious allocation, and accordingly, we lend into various sectors. So that is a guiding principle which is already there. The guardrails are already in place. So I think RBI wanted to formalize across the system. We are already practicing that. We're still working through it because, the impact is also on unsecured loan as well as on the NBFC loans. Now, both of these you'll have to calculate, but I'll give you a few numbers which are a bit indicative. Our overall exposure on the retail side in terms of unsecured exposure has been about 21 odd %. Incrementally also, it's similar in line with that. That I think will require higher capital. There is a separate line of credit to NBFCs, etc. So this doesn't include HFCs, so that has to be calculated. But as I said, it's one of the overall the exposure on unsecured has been a bit lower.
Cement companies reported a strong set of numbers for the September quarter. Volume growth continued to be robust. Profit and revenue soared as well. Mehika Barve joins in with a detailed analysis of the cement sector's performance in the second quarter.
Major Indian cement companies experienced a 2.84 times year-on-year surge in Q2 profits, fueled by robust demand and volume growth. Ramco Cements reported the highest profit surge at 19.46 times, while ACC returned to profitability compared to a loss a year ago. Aggregate revenue rose by 14%, with the top gainers being Ramco Cements and Shree Cements. Overall volumes also grew 14% year-on-year, driven by demand due to higher spending on infrastructure by the government, low construction costs, and a resurgence of real estate and individual home buying demand. Ramco Cements and ACC led volume growth at 37 and 17%. Furthermore, each company saw a double to triple digit EBITDA growth led by ACC and Ambuja, who saw margin expansion of 1,197 and 1,100 basis points. Overall margin expansion was on the back of softening input prices. Power and fuel costs declined 22% on an average, while logistic costs fell by 3%. On the other hand, raw material costs rose by 8% due to elevated slag and flash prices. The cement sector is also set for extensive capacity expansion for the upcoming fiscals. UltraTech aims to raise its leading capacity by 22 million tons by FY26, and Adani Cement also aims to double its capacity to 140 MTPA by FY28. Year-to-date, Ramco Cement has outperformed all the other companies at 40.13%, while ACC is the top loser at a negative 24.55%. For more such updates, stay tuned to BQ Prime.
As the earnings season draws to a close, how has India Inc. fared in Q2? BQ Prime spoke to Motilal Oswal's Gautam Duggar to assess the Q2 report card.
This quarter has been an excellent one. In fact, I would go ahead and say this has been the best quarter in the last 5-6 quarters. There are 2 or 3 reasons why I say that. First things first, the aggregates have beaten expectations across the board. We've seen a 48% earnings growth for our coverage companies, 242 companies, versus expectation of 40%. For Nifty 50, we have seen an earnings growth of 28% versus our expectation of 21%. And then if you do all kinds of cuts and analyze, X commodities, X financials, or X of OMCs, whichever set of aggregate you take, the earnings are beaten expectations. Second, the more important thing is the beat has been across the board. So if we make estimates for 21 sectors, out of that, 19 sectors have delivered numbers which are better than expectations or at least in line with expectations. There are only very two small sectors which have missed expectations, right? So this has been as broad and as you can say the most inclusive quarter that I have seen in a while, where every sector has come to the party.
That's all we have for you on Let's Talk Business. More news and updates after a very short break.